You ever see this happen? A company puts out some pretty rough quarterly numbers, and then an analyst report comes out screaming, buy. It kind of makes you scratch your head, right? Well, that is the exact situation we're looking at with KPIT Technologies, an automotive software specialist. They've just hit a bit of a rough patch, but one major firm is convinced they're about to take off. So let's get into it and see what they're seeing. And look, when we say betting big, we really mean it. The number we're talking about here is a potential 30% upside. Yeah, plus 30% from where the stock is today. So how on earth do you get to a number like that? What's the logic? Now, this isn't just some random guess. This number comes from a super detailed report put out by the financial services firm Motilal Oswal. And that's what we're going to do here. We're going to walk through their analysis piece by piece to figure out exactly how they landed on such an optimistic forecast. Okay, let's kick things off with the big headline, the main event really. This is the call that got everyone's attention. So there it is, plain and simple, a buy rating. And, in the world of financial analysts, a buy isn't just a casual thumbs up. It's a statement. It means they have a strong belief that this stock is way undervalued and is set to seriously outperform the market over the next 12 months or so. But, and this is a big but, this is where the story gets really, really interesting. Because, you see, to really get why this buy rating is such a big deal, we have to talk about the here and now for KPII. And, well, things have been a little bumpy. And here's the paradox, right? This glowing recommendation came out right on the heels of KPIT's latest quarterly results, which, to be blunt, didn't exactly meet expectations. In fact, they missed. So what exactly went wrong in the last quarter? All right, so when we say they missed, what does that actually mean? Well, analysts were watching two big things. How much is the company growing and how profitable is it? And the reality check came on both of those fronts. Let's dig into the specifics. First up, let's talk revenue growth. You can see it right here. Yeah, they grew, but only by 1.5% for the quarter. The street was looking for 2.8%. So they basically delivered only about half the growth everyone was expecting. Not exactly the start you want to see. Then you flip over to profitability. This chart shows what's called the EBIT margin. It's just a fancy way of measuring how efficiently the company is running its business. And you can see it dipped to 15.6% when the estimate was 16.1. Now that might not sound like a huge drop, but a dip like that tells you they're probably feeling some pressure on their costs. And the weakness didn't just stop at the headline numbers. You dig a little deeper and you see their main business, the passenger car segment, actually went down by 1.2%. The value of new deals they signed, that was down 14% from last year. And get this, if you ignore the companies they bought, their own organic revenue actually shrank by 1%. They even had fewer people working there by the end of the quarter. So yeah, it's a pretty tough picture. Okay, so with all that red on the page, where is all this optimism coming from, right? Well, this brings us to the absolute heart of the analyst's argument. There's a huge strategic pivot happening inside KPIT, and this is what their entire bet on the future is based on. They're making a fundamental shift away from the old model, which was basically selling engineering hours. Now they're focused on delivering complete, pre-built technology solutions. Here's a good way to think about it. Imagine instead of selling a car maker a box of complex, high-tech parts, you're selling them a fully assembled, pre-tested engine that's ready to drop right in. It's a game changer, because today's cars are basically becoming supercomputers on wheels. It's all about the software-defined vehicle, and car companies need these complete packages to stay competitive. And this quote from management really nails why they're making this change. This isn't some idea they cooked up in a boardroom. No, this is a direct answer to what their customers, the big car manufacturers, are asking for. They need stuff that's ready to go, that works out of the box, and that won't cause delays on their end. So the whole idea here is to create a win-win situation. For the car companies, it means they get the latest tech into their cars faster, better, and cheaper. And for KPIT, it means they get to sell a much more valuable product, which, down the road, should be way more profitable than just billing for hours. But look, a major change in strategy like this is never a straight line up. It's always messy. And the report makes it clear that KPIT is kind of fighting a war on two fronts right now. They've got some parts of the business that are doing great and other parts that are really struggling. And this comparison really shows you the split personality of the company at the moment. You've got Europe, which is growing at a solid 4.9%, and their commercial vehicles division is absolutely on fire, up 10.5%. But then you look at the US and Asia, and they're both going in the wrong direction, down 2.1 and 6.9% respectively. This chart really puts it into perspective, though. look at how important Europe is. It's more than half of their entire business. So that growth in Europe is literally the engine pulling the whole train forward, while the other regions are dragging behind. So what's going on behind these numbers? Well, the report suggests that in Europe, car makers are actually moving more of their work to India as they rejig their supply chains. But in the US and Asia, it's a different story. Car makers there are hitting the pause button on some big projects, reshuffling their budgets, and that's directly hurting KPIT's business in those regions. All right, so we've covered the tough quarter, and we've talked about this big strategic shift. So the big question is, how does the analyst connect these dots to land back at that very confident buy rating? When you boil it all down, the analyst perspective is this. They're calling this a consolidation year for KPIT, almost like a rebuilding year for a sports team. They're not seeing the current problems as a permanent decline. Instead, they see it as the short-term, predictable growing pains you get when you're making a massive change to your core business. And that's what brings us right back to the numbers we started with. The analysts are saying, look, once they get through this transition phase, this stock, which is sitting around 1,042 rupees today, is actually worth 1,350. And boom, that's your 30% upside right there. So if you had to sum up the entire report in one sentence, it's this. Motilal Oswal is making a bet that the huge long-term strategic shift is way more important than one bumpy quarter. They believe KPIT is taking its medicine now to build a much healthier, stronger company for the future. And that right there is the million-dollar question for anyone looking at KPIT, isn't it? The new strategy looks great on paper, but it's a race against the clock. Can the company prove this new model works and start delivering results before the market just runs out of patience with these messy quarters? It's the classic investment story. Short-term pain for long-term gain. The question is, will it pay off?